Hello everyone. Today we are going to talk about how to trade credit spreads for profiting $100 to $200 on each trade. Disclaimer: options trading involves significant risk, and even the best setups can result in losses. Never risk more than you can comfortably afford to lose. Always follow your own risk management plan, protect your capital, and make trading decisions based on your own research and judgment. But before we continue, if you are not already subscribed, please go ahead and like and subscribe to my channel Net New Universe, so you don't miss the upcoming videos like this. If you've been buying zero DTE options hoping for huge profits, you already know how difficult consistency can be. After years of trading, I realized there was a better approach for many market conditions: selling SPX credit spreads. My goal isn't to hit home runs. My goal is to consistently look for opportunities that can produce around $100 to $200 per trade while keeping risk defined and protecting my capital. Today, I'll show you exactly how I approach these trades. Every trade begins with market analysis. Before I even think about selling a spread, I study the daily, 4-hour, 2-hour, and 1-hour charts. I'm looking for trend direction, major support and resistance, supply and demand zones, market structure, important economic events. If the market is bullish, I look for put credit spreads below strong support. If the market is bearish, I look for call credit spreads above strong resistance. I'm not trying to predict the exact closing price. Instead, I ask myself one simple question: where is SPX least likely to trade today? That question alone dramatically improves trade selection. One mistake I see traders make is automatically selling today's expiration. I usually don't. Instead, I compare today's expiration with tomorrow's and sometimes even the following day's expiration. Why? Because 1 DTE and 2 DTE options often provide more premium. That extra premium lets me move my short strike farther away from the current price while collecting similar credit. More distance usually means more room for normal market movement before my short strike is threatened. I'm not looking for the biggest premium. I'm looking for the best balance between probability, premium collected, and distance from price. Another thing that keeps my trading simple is the spread width. Personally, I prefer trading 10-point, 15-point, or 20-point wide SPX credit spreads. These widths fit my trading style and usually allow me to enter and exit efficiently, while keeping my risk clearly defined. Before entering any trade, I already know my maximum loss, my target profit, where I'll exit if I'm wrong. Making those decisions before entering removes emotion once the trade begins. Patience is one of the biggest edges a trader can have. I don't rush into a trade right after the opening bell. I let the market establish direction first. Once buyers or sellers clearly take control and price confirms my analysis, I sell my spread beyond important support or resistance levels. Good entries create easier trades, bad entries create stress. This is probably the biggest difference between my approach and many other traders. I don't wait for maximum profit. As soon as my trade reaches roughly $100 to $200 in profit, depending on the position, I'm already looking to buy the spread back and close the trade. I don't need every dollar, I want consistency. Holding for the final few dollars usually exposes me to much more risk than reward. I'd rather lock in a good profit and move on, and 99% of the time I close my position on the same day I opened it. Even if it's a loss, I don't want to keep and wait for unknown risk tomorrow. This lesson has saved me countless dollars over the years. Many traders place a limit order and refuse to adjust it because they're trying to squeeze out the last few cents. Meanwhile, another trader gets filled first, the market moves, and a winning trade suddenly starts giving back profits. Instead, I manage my exit manually. I'll place my limit order above my target while the spread is moving in my favor. As the market gets closer, I adjust my order toward the midpoint. If necessary, I'll even give up a few cents below the midpoint just to get filled. Those last few cents don't matter. Actually closing the trade does. Remember, a profitable trade isn't profitable until it's closed. Trading SPX credit spreads isn't about getting rich overnight, it's about repeating a disciplined process. Study the higher time frames, choose the expiration that gives you the best combination of premium and distance. Use manageable spread widths like 10, 15, or 20 points. Wait for confirmation before entering. Take your profits when they're available. And never let greed over a few extra cents turn a winning trade into a losing one. If you can consistently protect your capital and repeat this process over and over, you'll put yourself in a much better position to become a disciplined and consistent options trader. Thank you for watching. If you enjoyed this video, please like, share, and subscribe to Net New Universe for more practical trading strategies. I'll see you in the next video.